Welcome to this Killick Explains video, and this time I want to take on something which is pretty topical. It's been in the press quite a lot recently, to do with pension funds. Now don't turn off the video. It's all about why, if pension funds are going to go into what are called private markets, and there are some hints they might do exactly that, they need to tread carefully. And they are under a bit of pressure from the government to do exactly this. So let's take a look at some of the things they'll need to be a little bit careful about and what it could mean for you. So the background to this is there is pressure on pension funds to essentially take a bit more risk, if you want to see it that way. The government are looking around thinking, our mandate as a government is to try and drive growth in the UK, drive investment. We want more money going into interesting parts of the economy, going into infrastructure projects, going into the stuff we want funded, all right? And therefore, we need to find a way to encourage pension funds to use the vast pool of capital they sit on to help us out, all right? Because otherwise we've got to borrow, and frankly that wakes up the dangerous bond vigilantes, or we've got to tax people more, and that's not politically popular. We can do efficiency drives, but that's easier said than done. So how about trying to persuade pension funds sitting on all this pool of capital, which is going to fund future pensions and so on, how about tempting them into the parts of the market we would like them to operate in? So what I'll do is I'll recap the two different types of pension we're talking about here, and then talk about some of the sort of risks around private market investing, and conclude with how this might be taken forward. So first of all, there are two types of basic pension. Now I'll do more detail on this elsewhere, so I'll just do the basics for now. First of all, there's the increasingly rare final salary style of pension, which usually only get if you work for the state or a very small number of private companies. And the reason for that is all the risk is on the person providing the scheme. Why? Because they've got to make lots of judgments, okay, in terms of getting it right. Because basically what they've done is they've said, we promise to pay our members a proportion of their final salary at a fixed age, from a fixed age, indefinitely, and possibly inflation link it as well. So we've got to make a judgment about how much we ask them to pay in, how much we ask an employer to pay in, and so on. So all the risk sits with the scheme provider, which is why they're brilliant for scheme members. It's why people like to have final salary schemes and why employers hate them, if you like. And there's then there's an asset matching element to it. So as the scheme provider, you have a team of actuaries sitting there going, well, if you've got a known liability in the future, because you can estimate based on expectations about inflation, average wages, average longevity and so on. If you know roughly what's coming in terms of an obligation to your scheme members, then you need a pool of assets that will fund that. All right? And famously, the Boots pension scheme worked out one day that it just needed to sit in IOUs, bonds basically, and it would have the assets it needed to pay all those liabilities. But most other schemes don't, so they'll hold some bonds, yes, but they'll hold quite a lot of equities. They'll hold a range of relatively conventional assets, all designed to hopefully go up in value and cover that liability in the future. So hold that thought for a moment when we talk about what other assets the government might like them to start moving into. Then you've got what are called defined contribution or money purchase schemes. Now this is the one that you've probably got, most people watching this video. It's certainly the type that I've had in the past. And this is where an employer says, I'm not taking all that risk. I'm not promising you anything. All right, what I will do is I'll pay in X% of your salary every month into a pension fund, right, to be invested on your behalf. You can pay in too, and in fact you should pay in too, all right, and then between us, hopefully we'll build enough of a pot that at the point where you decide you're going to leave work or dial it down, there's enough in the pot to meet what you need in the future. Don't know what that's going to be, because the pot could be any size by then. So basically the risk's on you. That's the member of the scheme, if you like. As an employer, I just agree to pay in a certain amount as a perk. Okay, I'll follow an agreed mandate. So the scheme will say, you know, we're a certain type of fund. All right, so within the scheme, you can basically set, you know, low, medium, high risk mandates and so on. And they'll probably do something called lifestyling just ahead of the point where you stop work or dial it down. So they'll take you out of riskier assets down into lower risk assets in the hope you can then go off into the sunset with your drawdown strategy in place. Now, with both types of fund, and by the way, more detail, I'll give you some places to go later on both if you want it. With both types of fund, the assets they hold really matter. Because if you're offering final salary scheme, Those assets have got to cover a liability calculated by actuaries going out into the future. And if you're running a money purchase scheme, your members are going to want the biggest possible pot by the time they come to draw on it. So, arguably, there are a few rules of thumb, because no one wants to retire or leave work or stop work with no income. All right? So, arguably, you can't just invest in anything. There are some rules of thumb. Risky assets, for something like a pension fund traditionally, have been things with no yield, all right? High volatility, low liquidity, stuff that's difficult to value, all right? And stuff where there's counterparty risk. Now, what the government would like to see pension funds do more of is move away from traditional safe stuff, bonds, equities, cash in some cases, into assets which I would argue all suffer from some combination of those risks I just pointed out. And to give you a list of the sorts of things that are potentially on the menu, you've got cryptocurrencies. This hasn't happened yet, but you've got cryptocurrencies. You've got private equity. You've got commodities like gold. You've got hybrid securities, as I call them. Hybrid or structured, that's where you get these exchange-traded funds that promise twice the inverse return of the FTSE and so on. You've got derivatives and you've got products backed by derivatives, all right? And private markets potentially is a phrase that covers any of those. Anything that's not easily accessible on the public market, okay, is potentially labelled as private market or alternatives, and that's a space the government would like to see pension funds move into with a higher proportion of their capital. So, what's my conclusion? My conclusion isn't actually that nobody should ever do that. Because if you get those investments right, the returns can be pretty attractive. But it needs a huge amount of judgment. I would hate to see a government mandate that sort of was a blanket approach, if you like. Hopefully, regulators will be all over it. All right, it is possible to add value to a fund by investing in those things, but it requires knowledge, experience, and care. So this is not a measure to be rushed through on a kind of blanket basis. And what this means is if the government goes down that route, and it does look like they are going to try and go down that route with pension funds, as investors, you need to be doing your homework. The government needs to do its homework. Investors need to do their homework. Product providers need to be doing their homework to make sure that they take the best of those assets on a risk-return basis and not all of the chaff that comes with the good wheat, if that makes sense. Okay, now I mentioned loads of jargon around pensions apart from anything else there. So to find out more, killick.com/resources has other videos. You've got a couple of guides, not this blue one, but a couple of guides. There's a purple and a grey one, all around saving for retirement. You could get those there too in digital format. And then of course in Confidant, our quarterly magazine, we often talk about this very topic.